The stock market is getting hammered once again in 2023. Not definitely for the first time, but probably for the longest time that we can recall since the bottom in October of last year. And particularly, this bloodbath is being led by small cap stocks, which are indiscriminately selling off much more than the large cap counterparts, as witnessed by the Nasdaq or the S&P 500. There is really no denying this, but we are truly living in a historically unique environment for investing as well as stocks and bonds. Not only have record high yields at nearly 5% on the 10-year made investments in real estate or even bonds nearly unsustainable, but buying stocks in this environment, particularly those of small caps that are laying off the most people in the economy, is becoming a hefty ordeal. As for why exactly that's happening and what we as investors can do to take advantage of it, well, that's exactly what we're going to address in this video. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. First things first, folks, let's get the elephant out of the room. If your growth portfolio, which is apart from the indices like the S&P 500 or the Nasdaq, has been underperforming for the past 2 months, you're not alone, because something like the Russell 2000 ETF has also actually tanked, unlike what major indices have been doing. Essentially, folks, there is a massive underperformance of small to mid-cap stocks and companies than the top 7 in the S&P 500, represented by our Amazons, Facebooks, Metas, Teslas, and Apple and Googles. As a matter of fact, for 2023, the S&P 7, as it is called, is up more than 50%, whereas the S&P 493 is basically flat, up around 2% for the year. And believe it or not, this gap we're seeing in performance has never been seen in modern stock market history, dating all the way back to 1984. And as for why I bring that up, well, because the Russell 2000 ETF I just showed you, which tracks small caps, was invented in 1984, meaning in all of history of the small cap market and investing in more speculative companies, right now has seen the worst performance of all time compared to what the broader index is doing. And although on paper there's clear reason to stay away from some of these smaller cap companies because of the effects of interest rates, in other cases there's actually investment opportunities brewing, because as we all know, a rising and falling tide lifts and drowns all boats. And that line has never been more true than today in 2023. If you divide the S&P Equal Weight Index by the S&P 500, which is weighted heavily towards big tech, we are still, again, at all-time lows when it comes to underperformance, dating back to 2020 and the 2008 financial crisis. And although at the time it didn't look like an opportune time to be investing in markets because of broader macroeconomic headwinds, but in reality, it turned out to be a good time to be a stock picker instead of an index investor. What I mean by that, folks, is that right now is the most opportune time for investors to really dial down on the companies that they are picking. Because following the insane growth we saw in the past 2 years, we're seeing a recovery to the mean, as clearly seen by the sharp decline on the right side of this ratio between the equal weight and the weighted S&P 500. And this means that some companies are going bankrupt, getting delisted from public exchanges, and many companies are getting consolidated and getting acquired by larger businesses, which means that valuations for these companies are extremely cheap compared to where bigger tech companies are. Your likes of Goldman Sachs and Morgan Stanley, for example, at this point in time, have a record amount of cash and a significant amount of profit. Because not only do rising interest rates mean they can charge their customers more for their deposits and credit cards, but it also means that the big tech companies like your Amazons, Facebooks, and Googles actually have record amounts of cash in a time of uncertainty. This naturally means these companies are going to be more inclined to do acquisitions and mergers, which gets translated into higher valuations for companies that might be taking part in the same segment. And although we saw a lot of these acquisitions take place in early 2021, a lot of them could also start reaccelerating going into 2024 as the Fed starts giving us a path to cutting rates. There are certain type of investors that are looking for a reason to sell their positions right now, and there's other types of investors that are looking for opportunity and reasons to buy. It's up to you to decide what kind of investor you want to be. Certainly in the short term, it's always difficult to see your portfolios red and be discredited by the broader investment community, but keep in mind that good fundamentals do thrive, and yes, although there's a chance your companies are going to struggle with the rising rates, there is always a point in history that can be used to validate the current narrative. So I suggest don't be a part of that specific narrative. The great inflation, as many people are calling this era, is being reckoned by the Federal Reserve as well as an insanely strong US economy. And that is exactly what's weighing on our favorite small cap stocks right now. As a matter of fact, EPS estimates, as you can see in orange, have already bottomed for the S&P 500 since March. And as we all know, markets are forward-looking, and that's why the market rallied since the start of the year. And this is fortunately potentially going to translate into a much more stronger and resilient economy as consumers and retail spending continues to improve, which, as we have seen, is already doing so. The reason why the 10-year yield has just hit a fresh 15-year high is all to do with uncertainty and with the strong nature of the current economy. Essentially, good news is now bad news, and that has been the underlying trend for markets for the past 3 years. But particularly for companies that are in more competitive environments like those with market caps under $50 billion, this time is more crucial to raise money, and as a result, your fundamentals, your balance sheets, and your income statements are going to be scrutinized much, much more. What all this really boils down to is understanding the fact that more stocks in public markets are making new lows right now, despite what the Nasdaq is showing us in blue. The red line is at 52-week lows, whereas the Nasdaq is up 30% for the year. This is a clear sign that we are still in a small cap bear market, and that the time to deploy cash has never been better, especially when it comes to valuations during high interest rate environments. Although the IWM can continue to go lower, it is hitting a support band around this 165 to 170 region, and we have seen multiple occasions of this index tanking to this area and then bouncing back very strongly. If the economic situation deteriorates, obviously my thesis could change, but as of right now, just like the opportunities in 2016 and 2020, I see this red in the IWM as an opportunity to invest instead of sitting on the sidelines. Now, obviously, you want to deploy your cash carefully and over time and not buy in once entirely. Make sure you do your own research as well, and obviously buy companies that you believe are fundamentally sound and also have a good opportunity to grow, because at the end of the day, that's what really matters in the small cap sector. As usual, folks, let me know your thoughts on the situation down in the comment section below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.